Hi, and welcome to part 4 of our 5-part finance series for teens. Today's topic is the magic of interest, presented by Break the Cycle Financial Coaching. In today's lesson, we're going to discuss the following topics. What is interest? We'll give you some examples of ways interest is used. The downside of interest, we're going to talk about the ugly side of interest and how it can affect you and cost you a lot of money. The upside of interest, we're going to show you the magic of using interest to your advantage and show you how compound interest can do wonders for your bank account. And then we'll show you how to gamify it. That's right, we're going to show you just a few ways your family can make learning about money fun. But before we jump into the good stuff, let me take a minute to introduce myself. I'm Rochelle Bollmeyer, a certified financial coach with Break the Cycle Financial Coaching. My husband Adam and I work together to share the knowledge we've learned during our own journey to becoming debt-free with our community. We also work one-on-one with families and businesses to make sure they're getting the most of their money too. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Albert Einstein. Wow, good old Einstein. He really hit the nail on the head with this quote. Interest can be either magical or a big pain in the rear. So what is interest exactly? Well, to put it simply, interest is the cost of using somebody else's money. Banks charge you interest when they loan you money, and you get paid interest when the bank uses your money to operate. So here are just a few examples of products that use interest. So we have credit cards, home loans, student loans, car loans, personal loans, and payday loans. Those are all areas where you're going to pay interest to the bank because you're using their money. And then you have stocks, savings accounts, CDs, high yield checking and savings accounts, and then some other types where you actually get paid interest because the bank will use your money to operate through those means. Now, who decides how much interest we pay or how much interest we earn? This is actually broken down into 3 different areas. The first is the Federal Reserve. This is the central bank of the U.S. It was created by Congress to provide the nation with a safer, more flexible, and more stable monetary and financial system. We have the U.S. Treasury, which is responsible for issuing all Treasury bonds, notes, and bills. And the U.S. Treasury is actually made up of 4 different entities. This includes the IRS, which handle taxes, the U.S. Mint, where they print our money, the Bureau of Public Debt. They're responsible for borrowing the money needed to operate the federal government, and they also account for the resulting debt. And then finally, the Alcohol and Tobacco Tax Bureau. They regulate and collect taxes on trade and imports of alcohol, tobacco, and firearms. And then lastly, we have the banking industry. Now, every bank gets to decide their criteria for interest rates. They go based on what the Federal Reserve is saying, as well as other factors like risk and your credit score. If you want to learn more about how interest rates are decided, visit Investopedia. I actually have a really great article I'm going to link in the description below the video, so that way you can find that. The average American family pays 14% of their income on interest alone. So now that we know what interest is and how it works, let's talk about the downside of interest. I want you to remember something. Borrowing adds up fast. Depending on the types of debt you hold as an adult, you could end up paying $8,000 or more in interest each year. And that's just for the privilege of buying things on credit. When you borrow money, you will pay interest to do so. The amount you pay will depend on several factors, including your credit and the type of loan you need. I've separated the types of loans based on how high the interest rates are that you're likely to pay. So we've separated them into good debt and bad debt. And we'll go over each of these categories in the next slides. First, we're going to talk about the good debt. Good debt includes things that you borrow to make your life better. Large expenses that most people can't get without the help of loans. These include home loans. A home loan is a long-term loan, and of all the loan types, is usually the lowest interest rate. There are different types of rates on home loans. For example, a 15-year fixed is usually the lowest, and recently that is around a 3% interest rate. A 30-year fixed recently is around a 3.5% interest rate. So, for example, on a home that you buy, let's say for $200,000, if you used a 15-year rate, you will pay an additional $48,609.39 in interest. And if you get a 30-year mortgage, you're going to pay an additional $123,312.18. That's over half of the price of your home just in interest if you do the 30-year. You also have a 13 or 15-year variable rate. A fixed rate means you will pay the same interest rate throughout the life of the loan. A variable rate means it will change based on the market. Next, let's talk car loans. Car loans are currently at a little under 4.5% for a 60-month or 5-year loan, or almost a 5% for a 36-month loan. So here's an example using a car. If your car costs, on average, which this is the average American car, $38,948. Again, that's the average price of a car in the US. A 36-month loan will cost you $3,000, a little over, and a 60-month loan will cost you right around $4,500. Now, again, that's in addition to the $38,948 that you're paying for the car. This is important to keep in mind when you're pricing cars. Now, student loans, those range from 4.79% to 7.41%. The average American borrows $37,172 to go to college. This means it will cost between $11,773 all the way to $55,573 in interest to borrow for college. Remember, all interest rates are subject to change, so please make sure to check with your bank for up-to-date rates. Now, let's break down bad debt. We call it bad debt because these types of loans usually charge much higher interest, but if you're able to manage your money the right way, you can avoid these types of loans altogether. Personal loans carry an interest rate of around 11.43%, and these loans can be used for almost anything. Example, depending on how much you borrow and how long your loan term is, you're going to pay anywhere from $62.99 all the way to $15,872 in interest on a loan of $1,000. Title loans and payday loans. These two types of loans should be avoided at all costs, as they range from 300 to 980% interest. These are often referred to as predatory lending. These loans range from $100 to $1,000, so you could end up paying anywhere from $25 all the way to $8,807.59 in just 1 year. Lastly is credit cards. Now, credit cards can be good if you know how to use them. If you're going to use credit cards, get one that will pay you to use it. For instance, a cashback card. And only use what you can afford to pay back each month. Interest rates for credit cards right now are around 20% or more. Now, a credit card is a little different. You're going to pay the interest on the amount you used on the card each month. So if 1 month you use $30 on the card, you would pay $6 in interest that month. However, if the next month you put another $200 on the card, you would then pay $46 in interest. You're going to be charged based on the amount you owe each month. If you're able to pay it off each month, then you will not pay any interest. Now, again, remember, the longer it takes you to pay off a loan, the more interest you will pay. This is especially important with credit cards and student loans. With credit cards, if you pay just the minimum balance, you will continue to carry your debt over each month and rack up interest. So if, again, 1 month you had $30 and you paid $6 in interest, and you only paid $10 on your balance, $26 would carry over. and you would pay interest on that amount as well as any new purchases. This is how compound interest works against you. In the case of student loans, a lot of people defer these. The problem with that comes if they charge you interest during that time. Now that we've gone over all of the negative sides of interest, let's talk about how interest can work for you. Here is where the magic happens, guys. Remember, interest is the cost of borrowing someone else's money, which means when you put your money in the bank and leave it, the bank pays you for the use of your money. This is because they use the money to fund loans and other bank needs. Now, there are very low risk ways to earn interest. However, the interest rates on these types of accounts are also very low. So while your various savings accounts will earn you some interest, you shouldn't rely on them to earn money. I want to make it clear, though, that you should use savings for your emergency fund. So here's just a couple ways to earn interest: savings accounts, money market accounts, CDs, high yield savings accounts, high yield checking accounts, and stocks. Now, let's talk compound interest. Let's look at two examples of different investors. Sam, at age 18, takes $10,000 he has saved up from an after-school job and money from birthdays, holidays, and graduation, and invests it into the stock market. He leaves the money alone and doesn't make any other contribution. Jill, like most of us, doesn't learn about the importance of investing until she's about 35. At this time, she decides to invest $5,000 a year to fund her retirement. Let's see what happens to each of our investors at age 65. Sam. At age 65, Sam now has $424,333, and Jill has $649,433. Now, you may see these numbers and think Jill's situation is the better of the two, but let's remember, Jill had to contribute $140,000 more than Sam did. If Sam were to continue investing just $100 each month, at 65, he would have $1,049,906. This means Jill would have turned $150,000 into a little over $500,000. However, Sam would have turned just $66,400 into over $1 million. And friends, this is the magic of compound interest. Remember, when you invest, you are buying a day that you don't have to work. Now, learning how about the right way to handle money can be very tedious and boring. It doesn't have to be, though. Luckily, there are several games that you can find for free or buy online that make finance fun. Here is a list of free games your kids can play, or your teens, to learn about different aspects of finance. I've included all of the links in the description below the video. Some of these, for example, investing games, we have Build Your Stacks, Stock Market Game, Wall Street Survivor, and How the Market Works. Some games for kids: Financial Football, Shady Sam, Money Magic, and Moneytopia. Now, Moneytopia, my kids have played recently, and my younger son, who's 9, really enjoys it. He has to make decisions, and it's a lot of fun. It is a little old school, and it is a flash game, but it's still pretty neat. And I don't even know how you save it, but it's still fun. Then we have some games for teens: Payback, Spent, Financial Football, or Soccer, and again, Shady Sam. And like I said, I'm going to link all of these games and the links to them in the description below, so you can find them easily. I also want to include some board games that you can actually play as a family. My family and I love spending time together playing board games. We play all kinds of them. I have included links to each of these products that I've listed on Amazon. I do want to let you know these are affiliate links, and we do receive a small payment from Amazon if you purchase, but of course, you don't have to. We're just giving you some examples of things you can get. These games include Cash Flow 101. This game was invented by the guy who wrote Rich Dad, Poor Dad. Buy It Right, Payday, Act Your Wage from Dave Ramsey, the Stock Exchange Game, Money Bags, and the Allowance Game. regardless of whether you choose the free resources or you buy a board game from your family, I really do encourage you to gamify learning about finance. Most people get what they know about finance and create their own money stories at home. So what better way to create a positive money story for your kids or your teens or teens for yourself than by making it a fun family venture? Lastly, I want to leave you with a quote. Every time you borrow money, you're robbing your future self. Thank you for joining us for the magic of interest. If you enjoyed this video, please make sure to hit the like and subscribe buttons, and stay tuned next week for our final video of this series, Budgeting for Teens. If you would like to connect with us, please visit our website, breakthecyclecoaching.com, or join our Facebook group. I've put the links to both of those in the description. Have a great week.